Insurance professionals work hard every day to keep people safe, but as technology transforms the industry, how can insurers protect not only their clients, but also shield themselves from ever-changing cyber risks? My name's Elizabeth Blosfield, and I'm the host of the Insuring Cyber Podcast, a monthly look into how the world of cyber and the business of insurance are connected. Hi, everyone, and welcome back to the Insuring Cyber Podcast. In this episode, we're diving into one of the big challenges facing global businesses right now, supply chain risk and the growing complexity of tariffs and trade policy. I'm joined by James Crask from Marsh, who leads their global advisory support for multinational clients, helping organizations navigate strategic risk. With a background in risk management, he brings insight into how companies can prepare for uncertainty, leverage emerging technologies such as AI, and rethink their approach to managing rising tariffs and global risks. Check out what he had to say. Hi, James. It's great to be speaking with you today. How are you doing?
I'm very well, thank you. Yeah, thank you for having me.
Yeah, I'm really looking forward to this discussion. I think it's a fascinating topic and a very timely one, too. So before we get into some of the questions, I was just wondering if you could give a brief overview of your background and some of the work that you do at Marsh.
Yeah, thank you. So at Marsh, I look after the advisory support that we provide to our multinational clients. So I'm working globally across Marsh, making sure that we bring the best of our consulting capability to support them on a broad range of strategic risk issues. And the last 5 years has been very heavily focused on supply chain risk, and then more recently tariffs and trade policy and all those kind of concerns. My background is not in the insurance industry. In fact, it was in risk and resilience in government here in the United Kingdom, and for the nuclear industry as well, having worked as a head of risk for the decommissioning authority here in the UK.
Oh, that's great. Well, I know you have great background, and that background in risk and resilience translates well to the insurance industry as well. And I know you mentioned what we're talking about today, sort of the current wave of tariffs and some of the supply chain issues that have been ongoing. This is a big topic for the industry. So I was curious just to start off some of the biggest ways that you've seen these new trade barriers kind of reshaping how companies are planning their, sourcing and manufacturing strategies.
Good question. We have seen an enormous amount of queries coming through from clients on this topic, wondering how to plan, what to plan for, and what to do under different types of scenarios. I think the challenge at the moment is really the uncertainty attached with what might happen. We've had tariffs announced, tariffs rescinded. We've had reciprocal tariffs suggested and then rescinded, and now we're in kind of the middle of a pause period, waiting for what might happen next. So that makes it quite challenging, actually, for organisations to take active decisions and actively do something about the risk, because you're not entirely sure how it's going to play out. So most of what our clients have been spending their time doing recently is scenario planning, effectively working out how they might be impacted under different tariff and trade policy scenarios, which is buying companies time to think about what actions they need to take, and crucially when they should take them if those scenarios are looking more or less likely. So we're kind of in that planning stage at the moment, I think, for most organizations. Having said that, there is evidence of companies taking some perhaps more tactical kind of steps to shelter the business against the potential impact.
Yeah, that makes a lot of sense. And I know, as you mentioned, there's a lot of uncertainty right now. So companies are sort of in that early planning stage. And so I'm curious, from your perspective, how should companies sort of go about quantifying risk or doing that initial planning?
Yeah, good question. It all starts with supply chain visibility, transparency of your supply chain. Now, most organizations know who their immediate suppliers are, the people that you're paying invoices to, and the companies that you're receiving goods and services from. So you can quite easily perform a relatively basic analysis of what the impact of tariffs might be based upon your knowledge of where those suppliers are sending you goods from. The challenge, though, is that sitting behind those suppliers is a myriad of a complex web of supply chains that sort of support those immediate suppliers, and seeing that supply chain, that upstream supply chain, is quite hard for organisations. Getting access to the data and the mapping and conducting the mapping necessary to actually see that supply chain is hard. And if you haven't got that, it's really difficult to do any meaningful quantification. So, as I say, you can kind of quantify the direct impacts coming from your what we call tier one suppliers, those immediate suppliers that are giving you goods and services on perhaps day-to-day basis. But the indirect impacts are harder to quantify. So imagine you were making, a washing machine in Europe, and you have suppliers in the US. Your tier one suppliers in the US, you can easily understand what the impact would be there. But hidden below that level, there could be a whole bunch of suppliers that are operating in Mexico, in Canada, in China, and everywhere else, that through the fact that trade is coming through the US to the to somewhere in Europe, you'll be buying cost or baking cost into the supply chain that will be invisible to you without that supply chain mapping.
Yeah, and this is really interesting because, as you mentioned, it's a very complex web and it can be sort of hard to navigate. And I'm looking forward to talking to you about how some of these new technologies, including AI, are sort of helping with that. But I'm curious also on the insurance side, how are underwriters sort of evaluating exposure for things like business interruption and supply chain coverage?
Well, I think in many ways we're still in that kind of planning stage, aren't we? I mean, I think thinking about the issues that corporates have around getting a firm understanding of what might happen and how these impacts might manifest is still hard to predict. And let's be honest, nobody can predict the future with any certainty. So there's lots of activity going on trying to sort of quantify the risk, quantify exposures, both at an individual client level or an insured level and at a portfolio level. The kind of discussions around insurance that we're certainly having quite a substantial amount of spending quite a substantial amount of time on relate to trade credit in insurance. So worrying about the risks associated with the creditworthiness of customers. Primarily, you're shipping some goods to a customer and worried about not getting payment back in return. There is also, as part of using trade credit, there's also an upstream kind of element to that, looking at using trade credit to help pre-purchase supplies from certain suppliers. So you might look to buy a year's worth of stock or enter into a contract for a longer period with some guaranteed kind of spending that might be attached to that. Now, there'll be some credit risk attached to that, which you can also transfer potentially into the insurance markets through trade credit. So that's been a lot of the focus. There's also large conversations, significant conversations around marine and cargo, relating to the increased costs of valuations of the goods, effectively, because everything that's been going into a country that has a higher level of tariff than it did previously, the goods are worth more than they were before, and insurance limits might need to increase. And for importers bringing material into the United States, they also have to be thinking about customs bonds, which again have to take account of the increased valuation of the goods that are coming in. So 20% extra, 30% extra, whatever the tariff might be. So that's where a lot of the conversation has been happening. The contingent business interruption kind of element of insurance for supply chains. We've been having that conversation with clients for the last several years. It's why we built our AI-powered tool Centris to help clients kind of better understand what their exposures are in that space, and seek to get better terms from their insurers or improved insurance coverage for CPI related risks.
Yeah, and this is really exciting. So I'm excited to talk about this because Marsh is doing a lot to innovate in the space with AI technology and sort of meet evolving client needs as the landscape is changing. So can you talk a little bit about some of the work that you're doing with that platform?
I can, yes. So Centris has been in the market for almost a year now. We launched it formally at RIMS in the US in May last year. So it's nearly a year old, but it's been under development for several years before that. Essentially what it is a system that enables us to very rapidly map an organization's upstream supply chain without having to go and ask suppliers for any information about who supplies them. So the traditional way of doing that mapping would be you phoning up the supplier and asking who you are supplied by and where they're located. And clearly that takes an awful lot of time and effort, particularly if you've got a large multinational corporate with potentially tens of thousands of tier one suppliers. So it can take many years, and the quality of what you get back can be quite limited as well. So we wanted to solve for that by doing it more rapidly, using AI as the kind of the driving force behind it. So we have access to some data that allows us to observe the physical exchange of goods taking place globally on any given day. And that allows us, with a large language model that sort of sits on top of the data, to very rapidly see the connections between supply chains. So I can see in a production location who the tier one suppliers are, and I can see the tier two suppliers supplying them and the tier three suppliers supplying them, and so forth. And we're looking for things in that data that are relevant to the production of whatever product it is you're producing. So if you're making a car, it's the stuff you need to make a car, not the janitorial supplies for the staff canteen. So we're able to strip out some of that noise. And then what we can do with Centrisk is then, once we have all of those sites geolocated, we can start to do some quite interesting things with risk assessments, both at the individual site level, looking at individual risks to individual suppliers, natural hazard risks, geopolitical risks, financial stability of suppliers, sanctions risks, human rights issues, the list goes on, and structural risks. So where at the portfolio level, you might see heavy concentration risk in certain locations where you might have lots of suppliers in one place, or bottleneck risks where you've got a single point of failure that previously was hidden to the organization. In fact, on that last point, the data that we've been running for some time now with Centrisk shows that on average companies, or 65% of companies, have at least one very critical single point of failure hidden somewhere within their supply chain that wasn't known to them prior to doing this mapping exercise.
Yeah, that's really interesting. You're doing so much work in this space to sort of make it easier to navigate that web, that complex web that we were talking about earlier. So I think this is really interesting. And I'm curious, congratulations on the year anniversary coming up on RIMS this year. What are some of the benefits that you've seen in the marketplace so far with the platform, and where are you looking to go with it in the future?
So on the insurance side, we going through this process allows us to have better conversations with insurers when we're helping clients get CBI coverage, and we've got examples of clients getting improved outcomes from those conversations because of the data that we're able to put in front of the insurers. And yeah, one of the reasons we built Centrisk was really to help the insurance industry get better at providing insurance policies and insurance products around supply chain risk. And the reason why a lot of these insurers were struggling in that space were similar issues to what corporates were facing. They didn't have the data and therefore couldn't really properly understand the risk, which made it hard to underwrite it. So we're seeing definite benefits there. On the tariff side, there's a lot of work going on at the moment using the Centrisk analysis to look at a portfolio level view of risk to help inform trade credit decisioning. We're working with financial institutions who are providing funding, to large portfolios of corporate entities, to looking at credit risk across those entities that driven by a supply chain view of the world. So that's on the insurance side, and there's more to come. We've got some bespoke products and offerings that we'll be launching soon. That hang off the data from Centrisk. So it's quite an exciting time to be involved in it. Then on the corporate risk management side, when we first started this, on this journey. We had quite a simple view of what we wanted to do with the data. We just wanted to help companies respond better to disruptions that came through their supply chain. But what we've noticed is that once you've captured all this data, there's an awful lot you can do with it. So we've helped companies, for example, think about their exposure to deforestation risk in their supply chain, which is a big issue if you have to comply with EU deforestation regulations. We can help organisations map their exposure to Uyghur forced labour under the Uyghur Forced Labour Prevention Act, so that you can actually get prepared to respond to a potential seizure of any goods before they enter the US customs area. So there's a long list of stuff that you can do with this data once you've captured it. And I think for us, supply chain is our starting point, but there's so much more we want to do with this kind of approach to unlocking the power of data to help clients get better insurance outcomes.
Yeah, that's great. And it sounds like an exciting time to be a part of the platform. And I'm curious, given everything that we've discussed so far, what's your advice to companies who are seeking to sort of reevaluate their risk management, in the face of these tariffs? And how can they sort of harness some of these new technologies to do that?
Focusing on tariffs, I think relatively simple process. I say relatively simple, but obviously come and talk to us and we'll walk you through this in detail. Step one is to get that visibility of your upstream supply chain. So you can use things like Centris to do that quite quickly with relatively limited input needed from either yourself or colleagues around the business. So that's stage one. Then run that data through an analysis of the different types of tariff scenarios that you're concerned about. So we have a tariff navigator that we use that plugs into Centrisk effectively to run that sort of assessment. Once you've got that, goods are coming from country A to B to C to D. You can then overlay on top of that revenue data to work out how much it's effectively going to cost you from a cost increase point of view. Third stage is then to do the stress testing. So what can we do about to protect the organisation against some of the downside risks associated with some of those scenarios that you might be modelling? And where are the opportunities? So, for example, you might be looking for alternative supplies that you can identify using things like Centrisk. And if you get there before your competitors, you might want to lock that supplier into a contract. So you lock out your competitors effectively and seize market share that way. Because the thing with tariffs is that if everybody's impacted at the same level, it's less of an issue, perhaps it's still an issue, but less of an issue than if your competitor is significantly less impacted than you, because clearly they're going to seize market share in some of the markets you operate in. The final thing I would say is that regardless of how prepared you are, spend time now, particularly in the period that we're in, the pause period that we're in, dusting off the business continuity plan, because you are going to see some level of disruption, even if you feel pretty protected.
Yeah, this is all great advice and a great framework for companies to follow to sort of get started. And this has been a fascinating conversation overall. I've learned a lot, and it's really exciting, all of the work that you're doing in this space. So thanks for taking the time to speak with me.